Folks, I wanted to give you a little update. Yesterday we had very, very bad retail sales data. And today we had really, really bad unemployment claims. Matter of fact, and I hate to say I told you so, but I did, but I want to show you something. If you go to jobless claims, you will see that we are at 885,000 new claims. The last claims report we had, we were above 800,000. Now, we are now going back to the levels that we saw right around March, April, May of last year when the market was not doing well. Now, when you take that into account with the fact that retail sales is not doing so well, did not do so well in November, and this data is fairly recent. It's updated weekly. This is bad. This is bad. Bad. This is not good. As a matter of fact, we went to almost, I think we dipped our toe into the upper 600,000s a few weeks ago, and then we started going back up. And here's the problem, and this is a big problem. This is what I've been talking about for the last several months, and it's finally catching up to us. We've got a situation where most people, 90% of the population, 80% of the population, most healthy adults who are the majority of the workforce are not going to get this vaccine till next year, till 2021. My doctor told me that I'm not getting it till about March, April, May even. And from what I'm understanding, people in Canada won't even get it till possibly the end of 2021. That's a problem because this vaccine, this virus is not going to wait for us. And that means the market could be on the tip of a major sell-off. Not a long-term sell-off, not anything to worry about long-term, but something similar to what we saw in late February, March, and April of this year. And I don't want to be the guy that says, hey, the market's great. This is a serious problem. This is stress. And I don't want to over-concern you, but I want to point out some low-hanging fruits. If the market drops, the stocks that are the weakest will go down the most. So I want to show you some stocks that are making 90-day breakdowns that I believe will go down if the market does drop. And I'm telling you right now, we may not have a big downside correction. It may be something small, but I'm telling you, based on the numbers, based on the jobless claims, based on the retail sales, based on my technical indicators like momentum levels, I think the market is stretched out and needs that rubber band to snap before we can go up again. And remember, in 2020, the NASDAQ returned over 40%. I believe it was something like 45%. It is overbought. That's not typical. That's very atypical. Even the S&P returned, I think, 12, 15%. The average return is 6%. So you have a rubber band that's stretched out, and it needs to contract before coming out again. So no, I'm not thinking of major recession. No, I don't think the market's going to go bear, but I think we're on the cusp, on the crest of a tidal wave, as they said in the early 80s. So I want to show you 4 stocks that I think will go down if the market does have a little correction. First is SP Global Inc. SPGI is the ticker symbol. Let me show you why and what. If you look technically at the stock, it is crossing the 200-day moving average to the downside. That means this stock is becoming bearish. It has not peaked since September 2nd, and it has been going down, and every high it's made since then has been lower. So I'm expecting with the 200-day breakdown and this descending triangle-ish type of a pattern that we're seeing here, I'm expecting more downside from this stock, especially with it breaking below the 200-day moving average. Ticker symbol SPGI. S&P Global. Next one, Crowdcastle International. Let me show you this stock. Let's look at a chart. And every one of these stocks is making a 90-day breakdown, which means it's trading at the lowest level in 90 days. And again, look at this stock. It hasn't made all-time highs or swing highs since the summer. It's been going lower. And if you look at it on a daily basis, it's now trading below the 200-day moving average. It's below major support. And if you look longer term, this stock looks like it can go down all the way down here. And it's at 150, it can go down to the 130s, 120s. I wouldn't hesitate. And again, it hasn't peaked since the summer, okay? So it hasn't really been showing a lot of strength. And that's in a market that's been extremely bullish since summer. So if the market goes down, I promise the stock will go down because, well, I can't promise, but I'm pretty confident it'll go down because of its low relative strength in comparison to the stock market. Remember, the weakest stocks go down the most. Next one is Tandem Diabetes. I've actually talked about this stock last time I did a 90-day breakdown, and it looks like it is going down. But again, below the 200-day moving average. Hasn't peaked since October. So as the market was going higher, this stock has been going down. Very bad relative strength. I'm bearish on this stock, tndm. If the market cracks a little bit, I'm telling you, this stock has the potential to go down to the $50 level. I'm not kidding. Next one, allo, allogene therapy. It's a strong sell according to bar chart, but I don't look at bar chart levels. I just look at the charts. And again, this stock hasn't, it peaked out 526 a long time ago. Hasn't been doing well. Stock market's been going this way. This stock has been going this way. And again, it's below the 200-day moving average. It broke support. It's at a 90-day breakdown. And if the stock market, takes a little breather, this stock is vulnerable. The weaker the stock, the more vulnerable it is. The stronger the stock, the less vulnerable it is. It's like Darwinian theory. The strong get stronger, the weak get weaker. So again, let me go through these. ALLO, Allogene Therapeutics, don't like this stock. tndm, Tandem Diabetes, don't like this stock. CCI, Crown Castle International, do not like this stock. And this S&P Global Inc., SPGI, do not like this stock. These are all dogs with fleas, in my opinion. And if you're looking to hedge your portfolio or you're looking to make money on the short side, these are probably some fairly good opportunities because they're breaking down. They're below the 200-day moving average. The stocks completely have been diverging away from the S&P 500 and the NASDAQ. And with the S&P momentum levels stretched out, you want to go for the low-hanging fruit. And these stocks are the low-hanging fruit. I hope that helps. Folks, the holiday season is in full swing. The only thing's missing is my Santa hat. We'll get that in the next few videos. That means you're probably shopping and entertaining relatives while trying to balance your hectic work schedule. I know how it is. I've been there. And to add to the stress of watching the stock market 5 days a week, and you might be feeling a little overwhelmed. So, we'd like to help you out this holiday season by giving you the chance to put more money in your portfolio or your stocking, whichever you choose. All you need to do is check out the Futures of Wealth head trader Lance Ippolito's weekly Blitz alerts. Inside, he'll show you how to spot unusual trading activity he calls shadow blitzes that could put cash in your hands within 24 hours. Who wouldn't want cash in their hands within 24 hours, I ask you? Click on the link below to get some holiday cheer and Lance's top trading secret. Do it now.